All right, hello. We'll go ahead and get started. Welcome again to the Netgain webinar series that we have here. We're starting with 842. We've got a few IFRS to accommodate the different time zones around the world, and then we also have a GASB webinar if you are interested up in the upcoming next couple of days here. But yeah, this one is focused on all things 842, which is the most exciting part of the lease accounting world to be in right now. So we'll move in. We've got some updates that came out today from the FASB that we'll touch on. So anyway, we're excited to be on with you. Thanks for joining. So I'm Adam Riches, and I a little bit about my background here. I'll be one of the presenters, and I'll be actually doing the demo, the live demo today. And I've been here at NetSuite since its inception for a little over 2 years. Oh, sorry, Netgain for a little over 2 years, and I was at NetSuite right before that for about 4 years, and then I had various controller roles for a couple of different publicly traded companies before that in industry, and then I started out my career as an auditor at Ernst & Young, which is where, incidentally, I met Nathan Smart here, so I'll kick it over to him.
Thanks, Adam. Yeah, this is Nathan Smart. As Adam mentioned, we shared a client together working 60, 70 hours in the beautiful June, July weather of Colorado. And so we've been close ever since. I wanted to give my background. I spent 5 years in Ernst & Young as an auditor, a couple of years closing the books for a large hospital group here in the Denver area. And then spent close to a decade with Deloitte Consulting, doing a lot of large-scale finance transformation projects, working with a lot of systems and implementation. So kind of the intersection between the process, accounting, and systems. So we're thrilled to be with you and talk about one of our favorite topics.
Yeah, and feel free throughout the session to hit, there's a Q&A button. Feel free to ask any questions as we go throughout. And if we don't get to your questions during the session, we could certainly, we have some time earmarked at the tail end to make sure that we do get all of your questions addressed. So yeah, feel free to ask as we go through this. So what we're going to touch on today is really the evolution of accounting and how we got to where we're at with the new lease accounting standard. We're going to talk about actually, well, in between there, we've got some news from the FASB that has just come out this morning. They've got their draft release on potential extension to the timeline. So we'll touch on that, and then we'll also talk about the impacts of COVID and what that has had on a lot of our client base and how they're managing some of the lease negotiations that are taking place right now. And then we'll talk about 842, the transition, and then I will go through a live demo to show how you can automate lease accounting under 842 as well. And then we'll have, like I mentioned, some time at the tail end for Q&A.
Excellent. So without dipping into going 400 years ago, let's go just 40 years ago. We wanted to give a quick evolution around lease accounting, just to give a context of where we are today. And I know 842 has been out there for a while. It was, but I wanted to give kind of the context for why it came about, why it was important, what the various activities involved that led up to that were. And so the accounting as was known up until recently really dated back to the mid-70s, where the FASB issued FAS 13, which was essentially your two classification of leases, which really had these 4 criteria that were indicators of whether a lease in substance was a financing arrangement or whether it was essentially a rental. And so what those criteria were really in place for those 40 years, and the FASB internationally just 6 years after the fact. And there was a big challenge here because a lot of lease agreements were structured around making sure they met the desired outcome. So I remember back in college, early 2000s, we ran case studies of leasing companies, the airline leasing company, and then the airline lessor and lessee. None of them had them on their balance sheet. So it was a big question of where did these assets exist on nobody's balance sheet. And so it was an interesting case study. So really during the early 2000s, we had some financial, some fraud, some challenges around off-balance sheet financing. And so the FASB and the International Accounting Standards Board, as part of their overall effort to converge standards globally between the FASB and the IASB, decided to undergo a joint project in 2006 on leases. It took them 3 years to come up with their preliminary views. I remember reading, a lot of back in the early 2000s about the kind of the arguments back and forth. Clearly, the consensus early on was that a lease agreement represents a liability, and there is an asset in that I have future benefit on my right to use an underlying asset. So the FASB and the IASB absolutely agreed on that. The challenge is they had kind of their great schism where they separated in terms of some key fundamentals and it really related around the balance between ease of implementation and accuracy on the P&L and where things. So unfortunately, they came to two different opinions. The International Accounting Standards is a single classification type, whereas the FASB elected to maintain the two classification types, operating and financing. From a balance sheet perspective, they wanted things to come on the balance sheet, but they did thought that the P&L should not be impacted. There's a good slide that kind of highlights what that looks like. So fast forward a few more years, we're getting just to a few years ago. ASC 842 became public in January 19, so for fiscal years beginning after December 15th, 2018. And the overall consensus, and we'll talk a bit today about this, the consensus, it definitely was a bigger undertaking than folks had realized. And so a lot of the public accounting or public companies who were slated to adopt in January 2019, there was a lot of effort in order to get the disclosures right, to get all the calculations. And so in October 2019, there was the realization that a one-year jump from public companies to private companies would be challenging, so that they just 7-8 months ago delayed ASC 842 for private and not-for-profit companies. And this was part of the broader FASB effort to essentially create two tiers and for major accounting standards have a 2-year delay between the adoption between the two buckets. And so that came out October 2019, just a handful months ago. And then here we are pushing towards January 21 as an effective date. But as we'll show, the FASB actually met a handful of weeks ago and this morning issued their exposure draft on another delay for another year in light of our current challenges we're all having with our global pandemic, COVID-19. But the big takeaway of this evolution is that what used to have this entire bucket of leases where they were firm commitments to companies, they were off balance sheet. And so now we're in a situation where most leases are back on, or not back, but they are now on the balance sheet.
Yeah. Thank you. So the reason this happened is greater transparency. This drove accountants, or at least accounting purists, crazy that these liabilities were not sitting on the balance sheet somehow and somehow accounted for. But like all things, obviously the pendulum has swung from the extreme of not having much at all, well, nothing on the balance sheet, and then just some minor disclosures, to now, significant impact in layers of complexity. So anyway, yeah, it's going to create a much greater transparency, and the accounting purists will be much happier after this, isn't it?
Sure. Yeah. And so just wanted to highlight with you, I mentioned that just a handful of weeks ago, the FASB met virtually over Zoom. We were dialed in from our remote locations as well. And they had discussed this, and it was very clear, the direction unanimously of the board, that they wanted to proceed with staff recommendation that in light of our challenges we're having right now with COVID-19 and business continuity challenges alone, in addition to staff workload, there was clearly a strong push and desire to push it out a year. And so the FASB is seeking public comment right now, so they've issued their exposure draft. The only real change in the exposure draft is the date. So from an accounting perspective, there is the accounting is essentially intact. It's just for private companies, those that weren't required to adopt in 2019 will have another 18 months of runway. I think the key learning from the delay 8 months ago was that a lot of people weren't putting the time and effort into it that they needed, and then in light of COVID, I think it's another additional challenge.
Yeah. So to be clear, now it's a full 3 years after the public companies and certain private companies adopted. There's going to be some concern on the feedback or the comments back. It was certain there's going to be some concern around comparability now, because now you have public companies running financials, under a completely different standard than private, and so there's going to be some concern there. So one thing that we would encourage you to do is to submit comments to the FASB and have an impact on this. But overall, I think this is a great way to relieve some of the pressure that private companies are feeling in other areas of the business. Instead of trying to tackle this, they can focus on the core business. And I think the FASB was pretty united in their efforts to try to give some relief to private companies that way. So we think it'll likely stick.
And then following up from here, there is one clarification. I apologize for the text here. We're definitely not going to read it, but there was a question the FASB had relative to the lease concession. So we've talked with a lot of our customers, and we just know globally there's plenty of challenges companies are having currently in meeting their lease obligations. So there's a lot of conversations between lessors and lessees around their lease agreements and what kind of concessions and such. And so the FASB, that was one of the questions that came up to the FASB staff on some clarification on the scope of these. So a lot of these concessions are really global in nature in terms of an entire population of leases. And so there was some clarification saying, hey, do I really need to treat every single underlying lease as a lease modification? So the FASB highlighted the obvious comment that the guidance did not contemplate some of the challenges we're obviously facing currently. And so the underlying premise in requiring a modified lease to be accounted for as if it were a new lease would not apply. And so this is a nice relief for companies that have modifications in scale too. And so what they highlight is that you can treat them consistent with how those would have been accounted as though they were in place early on in the lease. And so very next, we have the actual two options and so most common scenarios we're seeing is that a lot of lessors, landlords, et cetera, are offering deferral of payments. So taking, perhaps extending the lease an additional few months, or pushing payments but in substance, the overall lease agreement is effectively intact in terms of the rights and obligations as well as the consideration that's provided. And so you have the two options. I'll jump first to option B, is you can treat it like the current accounting standards allow you to. So what that means is, if I take an example where I have a 3-month deferral, I would have the modification where I take those 3 months, I extend my lease agreement, I recalculate what my present value of future payments is at my incremental borrowing rate, and I would remeasure the liability with the offset to the right of use asset. Everyone is perfectly welcome to use existing guidance for that. But they did want to give a sort of practical expedient.
Under scenario B, it would be kind of a standard modification where you're just adjusting the payment run, and I'll walk through that when I go through the demo. So that's pretty straightforward. Now back to A.
Yeah. Now A gives is essentially a nice it's sort of a practical expedience where what a company can do now is they can take their lease liability, their amortization schedules that they've built out for the entire lease contract, and they can not change the liability, not change the asset, but rather make any changes in payments as a reduction to their receivable payable associated with the lease. So that is a nice kind of roundabout way to not worry about adjusting your entire schedules prospectively, but just on the outside, recognizing that those payments will, in time, balance out towards the end of the lease.
Yeah.
So,
which isn't super exciting, at least from my perspective. Yeah. Like I think that one is meant to be kind of a relief, but it's just another thing you got to look at on your balance sheet.
Another balance sheet account to reconcile, right?
Yeah. So the question is, who's impacted by the new standard, right? And at the end of the day, it's anybody who is giving consideration in exchange for the control to use an identified asset. So they are very particular about identified assets, which puts software into this kind of no man's land of the software lease or.
Well, this is where the definitions differ between the FASB and the 842 and IFRS 16 or equivalent standards adopting IFRS 16, as well as the GASB even has their own third definition. So specifically for U.S. accounting, it is very clear the software is not an identified asset.
So it's, you're probably impacted if you lease assets, any asset, right? Short-term leases sometimes are excluded depending on the nature of them. But so getting into it, so what does this mean? This means in the past we had these off-balance sheet obligations that didn't sit under your liability section. Now it moves up, and we have a liability that equals the net present value of the future payments, and we have a corresponding asset that's based off of that calculation. So we now have an asset and a liability that generally balance each other out. And so essentially, lease accounting went from this, where you have a vehicle lease, a 3-year vehicle lease here for $500 a month. It's simply vehicle expense and accounts payable. This is under the old standard, very easy, no balance sheet impact. And now it looks like this. So now we've got varying journal entries every month. We have to put the asset and the liability on, and they both, of course, burn down at different rates. And so we have to measure the burn down of that asset and the liability accordingly in those monthly entries. This is an operating lease. As Nathan mentioned, there's both operating and financing leases. You'll notice here there's no finance or there's no interest expense. This is unique to the U.S. and 842 and GAAP companies, whereas this is the finance lease under 842. This looks like a standard lease under IFRS 16, where you do have interest expense here as well.
And then the big change here is really just in title. It used to be a capital lease, now it's a finance lease.
Yeah, same thing.
But the approach is the same, generally. Yeah, so we talked with a lot of folks. I think the key thing, and this was apparent in the rollout of ASC 842. This was something that I think the public companies who had adopted in early 2019, and there were even some Target who adopted a year prior to that. And so what universally was recognized that there was a lot more effort involved. There was things along the way. So I think, we obviously come from it from a software perspective, but what we want to highlight relative to the adoption of 842 is that the software element is just a small component. What you need to do as a company is put together a process and a project manager and owner in place to systematically and sequentially go through each of the steps involved to understand the scope, what contracts you have, what your operational strategy is relative to your leases, whether there are specific systems involved, and how you use those systems. But then so much of the work, heavy lifting really is on the configuration or the lease abstraction. So your data is your most challenging thing, getting going from your contract analysis into the underlying data. Most of that being because it's more than just the debits and credits. With the new lease accounting standard, it really is about all the disclosures and additional data points that are needed. And so it's important to come up with, and I worked in my 10 years working with Fortune 500 companies. They have the luxury of putting dedicated teams and double digits worth of individuals at larger projects. Whereas I know a lot of us small and mid-sized companies, we don't have that luxury. So I think the perspective there is that we need something that's coordinated but efficient in order for us to get from, number one, understand what the standard is, how am I impacted, and how can I go about getting the data I need, and what tools do I have to really not require me to understand 800 pages of guidance and interpretive guidance.
Mm-hmm. Yeah, we like to say that if you find yourself spending the majority of your time implementing software, then you've probably selected the right software. This is just representing all the information that needs to be considered and captured around the lease. Some of this is operational data like CAM charges and tracking those CAM charges versus actual variable rent and any termination or subleasing provisions in the contract, things like that may have an impact on how you actually account for them. And there's a series of practical expedients that the FASB has released to allow or to help make this transition easier. There's a few things. I don't want to talk about each one, but one of the ones that we've seen that has been really helpful for a lot of our private customers is the single portfolio, the ability to use a risk-free discount rate if you're a privately held company. So instead of trying to figure out your incremental borrowing rate and then applying that to a specific asset and coming up with those rates, which are very tough to defend against the auditors, you're allowed to just use the risk-free rates. Now that increases your liability in your asset because it's especially low right now, but that is something that we've seen that's been really helpful.
And the other transition relief that they call it a package. There's a handful of things, but one of the nice things for those of you who have clean accounting under 840, where you have built up your deferred rent balance or deferred rent balances over time, by using hindsight, you're able to use that as your beginning, essentially your beginning difference between your lease liability and right of use assets. So while every time you read the accounting guidance, you feel like those writing it need some direction and simplifying language, but as you read through it, it's a little challenging. But the nice thing is the ability to use that existing deferred rent as your gap between your liability and your right of use asset, and then moving forward prospectively with those offsetting and agreeing to each other, you really don't even have a go live impact.
Yeah, meaning you calculate the NPV of future payments for a given lease. You reduce out whatever balance you already have on the balance sheet for deferred rent, and that is what you would use to calculate your right of use asset. And then, there's no P&L impact or equity impact on transition. So Steve Bragg he's here in Colorado. We're based out of Colorado. He talks a lot about, he's got, a great website with a lot of resources on it, but he talked about lease accounting, and he said his concern is for the smaller companies. Nathan talked about the Fortune 500, whatever. They've got resources to throw at this. It's the small ones that are going to struggle to get this right. And then PricewaterhouseCoopers also said that it'll require significant process changes or significant system and process changes to get this adoption done. The FASB, interestingly enough, they delayed, that first delay that they pushed. A lot of the comments back were they thought that this was something that would be pretty easy to manage in spreadsheets. And they said their initial findings from the public company adoption was that overwhelmingly to the contrary, where they found that the majority of companies needed, even with just a dozen or so leases, even needed a system in place in order to get this right. And so that was one of the reasons for the delay. But again, it's just it's a lot more complex than I think the FASB intended.
Yeah, we partner with a lot of the accounting firms. But one of them specifically had highlighted that they've done their internal analysis suggests that people receive a positive ROI on an accounting investment in fewer than 10 leases. I found that interesting until I've seen a lot of these spreadsheets.
Yeah, we're fortunate to get these packets of spreadsheets to help customers transition, and they can get pretty interesting looking. So having said that, there's a couple of solutions here, a couple of types of solutions. When you go out on the market and look for solutions, you just know that there's these point solutions that are really number two. They're companies that have sprung up in the last couple of years and built solutions specific for 842. They're standalone systems. They have the ability to integrate, but we're not seeing a lot of customers or a lot of companies out there that are really actually integrating the systems. What they do is they take a data dump out of these systems and they'll upload those as a journal entry into their GL, into their core solution. So there's a lot of good things. These tend to be stronger on the accounting front, but they tend to leave you kind of hanging. They create the schedules, but they don't take it all the way through the process and get your journal entries booked. And they're not as strong on the lease management side, the real estate side. Number one, lease management products. These are companies, big companies that have been around for decades, have these kind of monolithic software packages that are expensive to deploy and develop, but they are very real estate specific. And so they can help you manage real estate and the efficiency of your leases, and they go well beyond lease accounting. In fact, they've added lease accounting kind of as a bolt-on at the last minute to kind of satisfy the standard. The struggle there that we're seeing is they are good on the real estate management side, but there are significant gaps, and there have been significant gaps on the accounting side. And this includes volume processing and getting all the information correct and modifications and things like that. So they're not near as strong on the accounting side. And then we have number three, which is the bucket that our solution falls under, but this is an embedded ERP leasing tool. Ours, so these tend to be specific around lease accounting that have functionality around property management. But what's nice about number three is they tend to be a lot less expensive because they're built into your core solution. They're easier to navigate and use. It's what you're used to using. But the important thing is it takes the process all the way through the journal entries. It rounds it out completely versus just kind of leaving you hanging with the schedules and having to deal with integrations and things like that. So our product NetLease is a great fit for people that are running on NetSuite, and we've also dabbled in the standalone space where we can run this standalone as well for people who are not on NetSuite. We're not going to go over this, but we do have our lease accounting life cycle, starting from the transition all the way through the termination of these leases, as well as some of these modifications. And so we'll go through that. On the right-hand side are some of the requirements under the new standard, which we won't dig into, but we built ours for 842 and IFRS 16 and the new accounting standards, and so we absolutely cover everything in the spectrum here. So with that, we've got a click-through demo, but I'm actually going to do a live demo here. So let's see if I'm still logged in.
So while Adam's navigating there, we have seen a couple of questions. I'll just highlight quickly. We absolutely are recording this. We'll share it on our website after the fact, and happy to share at least a condensed version of the slides with folks as they in order to pass along, share with others as well. We'll have both of those uploaded to our website.
Excellent. Well, I'm logged into NetSuite, and I'm logged into NetLease, our solution right here. You can see right here on the top of the tab with all the functionality that comes along with it. This is a pretty basic stand-up to install the bundle and get it running. But what I wanted to walk through today, so I'm on the dashboard. This is obviously configurable. We can move things around. But what I wanted to walk through today was actually just setting up a lease. I want to talk about, how we can export and kind of audit the Excel and then make any modifications that we need to.
We're obviously, we love to highlight and show our product. We definitely want to take it from the perspective of the accounting standard. We'll do this relatively simple here, but I think it'd be great if once we created this lease, maybe even do an export and show what those what an Excel-based schedule would actually look like, and how easily you could replicate between the two.
Yeah. So there's some criteria to distinguish between an operating and a financing type lease. Just if there's any question, 80% of leases are operating leases in the U.S., and so it's usually pretty straightforward. However, we do have, if there is a question on whether an equipment lease, for example, is operating or financing, we do have a wizard that'll walk you through the process. It'll determine what type of lease it is. So that is available. But again, for most leases, it's not relevant. So we have this bypass that I'm hitting right now, so you don't have to go through that.
And interestingly, for those of you that are still living in 840 and operating under there, the criteria, although they make a big difference, that they stress that there are no bright lines, but the 4 criteria are eerily similar, in fact, exact with what they were previously. So you'll still have to make some criteria, but that's an accounting decision election to make.
Excellent. So what I'm setting up is some of the key accounting information that will come right out of the lease contract. For example, this is a 24-month lease. In this example, I've got the initial payment of $15,000, but I'm going to have this be an escalating rent payment. So I'm going to have, I'm going to start on January 1st, 21. I'm going to change this to $16,000. So first year's 15, second year's 16,000. This is common in the real estate leases that we see. I've got some other things that I can add in here, but I am going to just go ahead and save this record because I have the information I need to generate the schedules here. So from here, I'm going to go in and generate the schedule. One thing you'll notice is that this is in pending status, which means I can change any of the variables while it's in pending. I can go through and I can change the incremental borrowing rate. That's the most common thing that we see changing. And then I can rerun the schedules. It's not until I I set it to commence that this will actually be locked down and we'll start booking journal entries against it. So this is really just just know this is in draft mode for now. But you can see what it's done is it's calculated the lease liability balance based off the net present value of those future payments. And then that's also, because we didn't have any prepayments or initial direct costs or incentives, the asset balance is equal to the liability balance in this case. And what we do is we generate the full amortization schedule, and everything's on the same schedule. So we have your payments, your assets, your liability, the reduction, and then your straight line lease expense on the right-hand side here. So everything is here, and everything is fully auditable. So I'm going to go in, and I'm going to commence this lease, and then I am going to export this into Excel. So what we commonly see are the auditors are requesting support for the transition. And so I'm going to go in and click on my report here, and this is lease 2391. And so I can go in here and produce this schedule right here. So this is the exact schedule that we had just produced, but now it's in a format that I can export this into Excel. So what I wanted to show here, and I'm going to open this up and share my Excel spreadsheet here. So this is that amortization schedule, but now in Excel.
And part of the reason we want to show this because it's challenging. We've seen tons of different That's, you're in the right of use. You need lease liability balance.
Oh, sorry. So what I'm doing right now is I'm backing into the net present value for that lease liability, just to show there's no voodoo here as we generate these schedules. So in this one, the payment was in advance. So I'm going to pull all of the subsequent payments after the first period. Now, if payment was in arrears, we would calculate this kind of the normal way. But then I'm going to add in that initial period. And if I've done this right, here I'll undo that and redo that. And our calculation comes out exactly to the lease liability value. So what we see, so first and foremost, if you want a schedule, an amortization schedule template, feel free to reach out and we'll absolutely send you our amortization templates so that you can build out some of the lease schedules that you have or need to build out. But again, this is a direct output of our system, and you can back into these calculations and send this off to the auditors and make them happy. You can also send this off, I always joke, in PDF format if you need to slow them down at all in their audit work. We're ex-auditors, so we've seen it all. But from here, again, you can rebuild the whole schedule just using basic formulas there as well. But I wanted to go in now, and I want to run the journal entries for this lease to show you that, so an embedded ERP tool will take it all the way through to the journal entry processing. So usually you'd run it wide open, but I am going to run it for just the lease that we have created because this is in my demo account. Just know that our system, because NetSuite supports foreign currency, we also support, we kind of piggyback on the rates and all the native functionality inside of NetSuite to run foreign currency. So if you do have any foreign currency leases, they can be managed in here as well. But what this is going to do is it's a record that shows the full audit trail, who ran the journal entries and when. We would obviously want to restrict this down to just those key individuals that you want booking the journal entries at month end. And then after it's complete, you'll see all the journal entries that were run as part of this lease. And I can drill into it from here, or I can go back to my lease and I can refresh this, and the journal entries will show up right here on the side of my schedule. So I can go in and I can take a look at what was hitting the GL through these journal entries. You can see on the initial balance setup, we have that $354,000 that we calculated for the liability and the asset. On transition now, if we're cutting over mid-lease, we would have a deferred rent balance in this case because we had the stepped rent on this particular example. So whatever was sitting in that deferred rent balance amount would show up here as an offset to a clearing account. So you would write off all of those deferred rent balances to that clearing account as part of our process for cutting over inside of NetSuite. And then, of course, we've got the amortization entry. So we've got the actual payment, and then we have our straight line rent expense. We've got our lease liability burn down, which is the difference between the actual payment and the effective interest for the period to come up with that calculation. And then under the plug method, we've got the difference showing up under the right of use accumulated amortization amount.
I think this is one of the key things too. So, any software tool out there will generate those schedules. You'll essentially get the 4-line journal entry here, whether in a CSV uploadable format or separately. But one of the nice things about an embedded tool like this is the ability to then not just trace these back to the underlying schedules, but then how it interacts with your existing AP. So that schedule generation and the journal entry essentially format is where an outside system will stop, and this is where you could pick up and realize the benefits of your full ERP system.
Yeah. And of course there's things too, like, so some things that I don't want to spend much time on today, or we can also, manage your 840 schedules if you haven't transitioned yet. And then we have a cutover process where you hit the button and it will book those balance sheet items and get you transitioned onto 842. So we've got a lot of customers that are private companies that are waiting to hit that button when they elect to go live. with 842. Also, we can do, we can run a financing schedule here like we showed. That's really the principal function of our IFRS solution, is really just running those financing leases instead of both. And then we have multi-classification. So this is where if you have a lease overseas, you've got a reporting requirement in London, for example, or in the UK, you can run financing type lease on those financial statements, but then properly recognize it as an operating lease in the US, and using multi-book, we can hit the separate GLs that way. So we have the accounting covered. But when we go into, we also have some property information. We can track the actual executed lease agreements. We can look at different contract provisions. We can take this deep into the property management front as well. We've built the tools in here. We've got, even maintenance if you want to take it that deep here as well, so which we do have some customers that go that far. But what we've seen is that a lot of customers want to do that, but they need to get the accounting done first, and then they move into kind of operationalizing down the road. So, but what's been interesting over the last couple of weeks is, we go through the implementation and then the training, and, we talk about modifications in the training, but a lot of our customers kind of, nod and say, okay, whatever, let's move on. And it's interesting because in the last couple of weeks, we have gotten a lot of calls about modifications as companies go through this, and they get provisions that, Nathan talked about earlier, where they may get 2 or 3 months free rent, and then move into and then have to modify the lease accordingly. And so, to be clear, like, these are real modifications that need to be addressed, any type of change to the contract. And now there's a couple of modifications that we support all the types of modifications, but there's 4 different types of modifications in the standard in 842. The first is one that's so significant you need a new contract. In that case, we terminate it and we start a new lease. The second type is a standard modification, which you're changing basic lease terms. So you got 3 months of deferred rent, that's one of them. You change your incremental borrowing rate, that's another. Or you take you extend the lease by another year. Those are some of the basic ones. And in that case, we're just writing up the right of use asset. We're changing the right of use asset and the liability balances by the exact same amount. So there's no P&L impact. But then we have somewhere there's a right of use impairment. We're seeing these now too, where you may abandon a restaurant and you still are on the hook for the lease payments for that restaurant, but you are not, but you're no longer going to be using it. So we have to write down the asset, and that does have a P&L impact, obviously, as we write down the right of use asset, but maintain the lease liability. And then there's a third, which is a decrease in scope. This is where if you have 2 floors of a building and you negotiate it down to just 1 floor, that's a partial termination. So there would be a P&L impact to that as well. That's the most unique of the 4. But I do want to run a standard modification here. So I'm going to leave the term the same, but instead of the lease being $15,000, I'm going to say effective April 1st. No, I've already booked. Effective May 1st. This is going to be $0, and we're going to get relief for 3 months. So we're going to say now effective, 9/1.
4 months.
That is 4 months. Sorry, I'll do 3 months here. So effective August 1st, this is going to go back, but it's going to be a higher payment now. So instead of $15,000, it's going to be $15,500. And then we're going to have the reset. Maybe it carries in January 1st, instead of it going up to that $16,000 that we had. It's going to go up now to $17,000 to make up for the difference in those 3 free months that we got. So I am now going to go back and modify this lease. And what it's going to do is it's going to take into account that adjusted payment schedule, which was, as we learned about the FASB, is one of the options for managing these modifications. And what it's going to do is adjust the right of use asset and the lease liability accordingly, according to that new schedule. It's going to account for the rent holiday that they've now been granted for May, June, and July. And it's going to rebuild the full schedule as well as booking the journal entry down here. So when I refresh this, it does take a minute here because it is running all of those processes. We have our modification journal entry. You can see that this did impact this quite a bit. So our liability dropped by, what is that, $31,000, and the right of use asset dropped by the exact same amount. So if I open the modification, you'll see that in the modification there's no income statement impact. This is all all balance sheet. So the asset was decreased and the liability was decreased as well. And then we've rebuilt the schedule. You can see over here now for May, June, and July, we've got 0 rent. And then you can see we've stepped up to $17,000 in that last year, which was different than the original lease terms. So we try to make it as easy as possible to navigate these, but the challenge is and this is one of the things where spreadsheets start to break down. It becomes very complicated to run through these processes in a spreadsheet and get the modifications exactly right. So with that, I wanted to move off of the lease record and talk about a couple of reports. I want to leave 10 minutes here for, I could go all day. I apologize. I love walking through the actual transition and walking through this. But we've got all the reports for the disclosures that are required under the new standard, and we can walk through some of the impacts. We can forecast what the impact of adopting the new standard will be well in advance. But a few of my favorite reports are, we have our, this one for sure, the lease balance roll forward report. And then we've got the lease payment waterfall report. And then we also have our, I'm looking for Nate, where's that?
How much we're talking about?
Oh, sorry, I had the roll forward report in there. Yeah, okay, sorry, waterfall and roll forward report. The roll forward report is similar to an asset roll forward report, where you've got your beginning asset balance, any additions, terminations, or other changes to your assets to get to the ending balance. We've got the same thing with a lease, with your lease balances as well. And this is one thing that is unique to our product. This will certainly be the standard down the road that the auditors will ask for, but we automate the creation of this. And so I can from here drill in to any one of the leases and then drill into the actual one. So this is the one that I created here, and then take it all the way to the lease level by opening that up right here on a new tab. So what we recommend when you go through the audit is to produce this report in all of its detail for all of your leases, and then export this into Excel, kick it over to the auditors, and then have them make the selections and come back. And we can go in and we can actually drill into the transactions that are underlying this. You can see we have some of these represent modifications and things like that are in here. We can drill right into the actual journal entries for those as well. So this is my favorite, probably because this gives you a true representation of what's in your lease portfolio. And then we get into the waterfall, and this is where we can forecast forward what those minimum payments are going to be. We can also forecast forward what the expense is going to be on a separate report as well. And for those financing type leases, we can look and we can separate your interest expense versus your amortization expenses there as well. So this gives you that full forecast capability as well. And these are all reports that come canned right out of the solution, ready to run on day one. So with that, I think that gives us a solid 10 minutes here to walk through Q&A, unless is there anything I missed here that
Oh, that's great.
worth showing there?
Summary slides, maybe, but
All right. Let's see here.
And I guess in summary, to be clear, the accounting guidance is significant. It is a big impact, but the fortunate thing with accounting is that it is finite. There are tools there that are available for you to help out. There's plenty of resources. Fortunately, there's for all of those that went before us, there's plenty of disclosures. And so if you haven't read, if you pick your favorite, one of your favorite companies you like to spend money at that's public, go to their disclosures. And, from a accounting and disclosure perspective, you know, that's one of the big impacts where lease accounting used to be, or the lease liability portion was part of your FAS 5 commitments and contingencies footnote, where you said, here's my undiscounted lease payments over the upcoming term. That went from part of a broader footnote to its own standalone footnote, where you're adding weighted average terms, weighted average discount rates, a lot of other disclosure information. So if you haven't done that, that is probably a great example to pick up a few public companies, look at their disclosures, and start getting a sense of how that might impact your company to do a similar disclosure.
Yeah, it really is great. In the early days, it was the Wild West. The auditors didn't know how to audit. The transition and public companies were struggling to get guidance on exactly how to make the transition happen. So it really is nice, the relief that the FASB has given and looks like they'll continue to give for private companies as they transition in. Yeah, it's getting much. It's a lot clearer today than it was in some of those early days when we walked through the implementation of public companies. So yeah, with that, I'm not sure if there are any questions on the board that need to be answered.
Megan, do you?
Yeah, we did have an additional question come through. It's how do I identify leases in my contracts?
Yeah, so it fundamentally goes back to the definition that was highlighted. So the definition, to be clear, the different elements of a lease arrangement has changed from 840 to 842. So it's good to refresh and solidify yourself what the definition means. And I like the simple diagram, lessee, lessor. The lessee is giving a right control over use of an identified asset. So think of those agreements where you have something tangible that you get the ability to use, and then take those and where you're giving consideration. Now, consideration doesn't have to be just financial. It could be other measures as well. So it's consideration more broadly. But if you have a scenario where you have agreements, those are your prime areas. And keep in mind too that a lot of agreements, the important thing that's called out here is the lease and non-lease components. So an agreement may be for a copy machine and services, and there's additional things. So the standard really segregates in your contract. That's what you want to isolate. You isolate the piece that relates to that underlying physical asset. Sorry, I tend to go along with it. Megan, any other questions?
Yeah. An additional question is, how much time should I plan for the project to transition onto 842?
That's a great question. And I hate to say, I mean, it depends on really the number of lease contracts that you have. We've walked through this with, and how readily available the data already is. With the requirements under 840, if you have a heavy real estate lease portfolio, you may already have a lot of the data that you need to transition. And so identifying the leases and abstracting the data tends to be the most labor-intensive part of the transition. There are some accounting decisions you need to make around the practical expedience, although the deeper we get into it, the more we know exactly what ones everybody takes and which ones nobody takes, so that's even a lot more straightforward than it used to be. And the system stand-up, if we isolate the system piece, again, it depends on how ready your data is. If your data is ready to go, we can have it stood up. We install the bundle, and we do some configuration. We've had some people stood up, in some, where they needed it stood up quickly. We had them up in a few days. Other scenarios, is a few weeks. And again, depending on how ready the data is, sometimes it does take a few months just to get the data ready to import into the system. I would take a look at your portfolio, see how many leases you think you may have. If you've got a global company, it's certainly going to take a lot longer, but certainly this is the reason for the extension. Yeah. The FASB has seen, heard from a lot of private companies that are struggling, and it's taking longer than
an additional driver of the challenge is, and we all as accountants can empathize with each other, is that we're the best at taking on the most with the least amount of people. And so candidly, one of your big challenges is going to be is that your monthly close is still going to be happening. You're going to still have your other activities that take place. You still have your internal reporting that you have to take care of. And so those typically, as we've seen projects that initially had a timeline that was in the weeks time frame where it's gone into months, it's really been availability of resources. And I think that is the underlying basis for the FASB delay as well, that recognition that we're going to be stretched even further.
And interestingly enough, we've seen an uptick of activity on our ongoing implementations right now, where everybody, seems to be working from home or remote, and has a little bit more time in the day because they're not commuting or chatting as much, I guess. I don't know.
Yeah. All right.
And I know we have just a few minutes left. We do have a couple other questions. One is, does your lease accounting solution account for ASC 840 and 842, or just the new accounting standard?
Oh, yeah. So for us specifically, absolutely. And so what Adam had highlighted, so under the 840, it's really, and we're talking about operating because financing leases, other than the name change, are not significantly impacted. But from an operating perspective, the current accounting is really is the same from a P&L perspective, your single lease expense. And so what our solution will do is we can load that information, account for it using the single lease expense. Any differences between your lease payment and your expense build up in your deferred rent account. And what our system will do, it will automate the transition onto that go live date, assuming you've taken the expedient that allows for the hindsight to use existing deferred rent balances to load to your plug. It's really just a one-click movement from 840 to 842.
Okay, thanks. And I think we have time for just one more. Is there a benefit to adopting early, or do we need to wait until 2021?
I certainly don't need to wait till 2021. Yeah, as the previous question, we manage 840, so that's the approach a lot of our customers have taken, is they'll adopt early, get some of these schedules in front of their auditors early, and then when the time comes, they've got all the data ready to hit the button and go live. So yeah, certainly no need to wait, and you can the standard allows for early adoption too. So a lot of these people that are ready to go are still going to adopt January 1st, 2021, or even mid-year this year in some cases for private companies. So.
And additionally, although we highlight that 842 is a significant amount of work, 840 is too. You still have those schedules, you still have the aggregation of details, and so having it all in a system and having that kind of just biting the bullet, getting it done with is definitely great for comparability as well. If some of your competitors or industry is already mostly adopted.
Or if you're private equity backed, that's where we see a lot of private companies that are adopting early or private equity backed, and and the PE firms are requiring early adoption so that they can compare portfolio companies. So if you are private equity backed, it's probably a good topic to address to see if they do want you to adopt earlier than the standard requires. So with that, it looks like we're at the top of the hour. Megan, we'll kick it back your way.